All right, so go over to page 11. We're talking about keeping in control and buying these back. We'll cover the other pages in just a second. The word buyback, what does that mean? To buy back. It means to buy the same strike price, same amount of contracts, and the same month, the same expiration month. To buy it back. Again, that is a jargon term. But now, however, the word rollout, what does rollout mean? Rollout means to go out to the next month. So if we bought back the $80 puts, then we sell the $80 puts for July if we just bought back the June. Y'all see that? So rolling out means roll out to the next month. But you don't have to roll out to the same strike price. You could roll out to a higher strike price, or you could roll out and roll down to a lower strike price. So in our example where we bought back the $80 puts and we rolled out to the next month, but we sold the which ones? Do you remember our example? The 75s. We bought back the 80s and we sold the 75s. So you can roll out, but you can also roll down. So you can roll up to a strike price, point C, or you can roll down to a strike price. All right, now let me give you the term that you'll hear me use throughout the day, the word wind out. Let me give you a definition for that term. Wind out means, when we talk about winding out of a position, means the exact opposite of what we did to wind into a position. In a few minutes, we'll be talking about spreads, bull put spreads, for example, where we sold a put and bought a put, right? So if we sold the $80 put and bought the $75 put, that's what we did to wind into the position. To wind out of it, we will buy back the $80 put and sell the $75 put. So to wind out means to do the opposite of what you did to wind in. Exactly the opposite. So don't make it complicated. That's really an easy term to understand, but we'll go through several examples to make sure you really have it down. Again, winding out means to buy back. It means to do the exact opposite of what you did to get involved in the spread or in the position in the first place. Okay, let's make sure we've covered everything now on page 9, page 10. When you buy a call option, tell me what has to happen for you to make money on this deal. Back to Coca-Cola. If you like Coca-Cola at 70 and you think it's going to go higher and you buy the $70 call, what has to happen for you to make money? The stock has to go up, and therefore the underlying or the overriding option will go up, right, in whatever relationship. What if the stock stays the same? You spend $4 to buy Coca-Cola. It never does go below 70. Matter of fact, it even goes up to 71 or 72, right? And on expiration, what's going to happen to your $4? Let's say the stock settles in around $70. What's going to happen on expiration? That $4 is going to go down to 2 to 1 to 0, right, depending on where the stock price is. So the stock has to go up in a call option. If it stays the same, you lose money. If it goes down, what happens, obviously? You lose money. Okay, let's talk about puts. If you buy a put on a stock, what are you hoping for? You buy a put. You own a stock right now, and it's gone from $60 up to $120, right? You really like this stock. You think it's going to go to $150, but you really don't know. So you don't know. So what do? If you buy a $120 put or a $110 put to hedge as an insurance policy, so if the stock goes down, your put goes up in value, right? So the stock goes down, your put goes up. That's a nice little hedge. But what has to happen for you to make money on your put? The stock has to go down. What if the stock stays the same? You lose. What if the stock goes up? You lose. So when you buy things, there is a 1 in 3 chance of making money. 1 in 3. Doesn't seem like very good odds. Heck of a lot better odds than Las Vegas. But if you walk up to a table in Las Vegas and said, you know, there's only a 1 in 3 chance you're going to win here, you probably wouldn't do it. Yeah, it'd be crowded, that's right, because it's like a 1 in a million chance of winning there. And people are standing in line at the tables. All right? So you lose more often than not. And people wonder constantly. And here's the irony. You may get good. You may have $4,000 that becomes $6,000. $6,000 becomes $11,000. $11,000 becomes $18,000. $18,000 is $28,000. But now you're sitting there 3 months later saying, my goodness, you know, $4,000 is now $28,000. This looks really good. And if you leave all your $28,000 at risk, if you leave all your $28 on red, if you leave all your $28 on the table, what will happen to it? It will go away. The stock market, like Las Vegas, is designed for the house to take back your money. It is designed that way, and it will happen that way. And so you've got to take your $4,000 and get out. And I would rather see more control and more discipline in my life and in especially my students' life. I'm getting pretty good at it because I never. Even you guys see me on whim? How many ever see me risking $100,000 or $200,000? Hardly ever. Sometimes on stocks I do that when I'm going to do a long-term hold or something. But man, you on options, or you see me doing little $3,000 and $4,000 and $5,000 trades all the time, yes or no? And I've got millions of dollars in my account. Why, if I have millions of dollars in my account, am I still doing $3,000 and $4,000 and $5,000 trades? Because I would rather do 50 $3,000 trades, right, than one $150,000 trade. Does that make sense to anybody else here? Quit putting it all on red. Quit leaving it all exposed for the same month, the same strike prices, the same stocks. Diversify that out. Be very, very careful with your money. 1 in 3 chance of making money is a theme. Now let's turn it over. Let's move on down to the next one. If you become an option seller, you now have a 2 in 3 chance of making money. Let's explore that possibility. Even using our same example. If we think that this $86 stock is going to fly, it's going to take off and go up, and we sell the $80 put for $3 or $3,000, that's a nice deal. If the stock goes up to $92, $93, $95, do we make money? Yes or no? Yes, because the put price goes down. What we sold for $3, we could even buy it back at a cheaper price or let it expire and keep our $3. What if the stock just stays at 86? What if it stays the same and doesn't hardly go anywhere? Do we still get to keep our $3? Yes or no? Yes, as long as it stays above that $80 strike price. It can even go down a little bit, could it not? It could go down to 84, 82, 81 near expiration date, and we could still make money. What if, see that? There's a 2 in 3 chance of making money when you sell. My point, get better at selling. I know it's tough for a lot of people to do. Mentally, it's easy to buy and then sell. And I'm trying to get you to change your whole way of thinking. Sell and then buy. It's a whole different way that you've got to look at life. Sell first. Be consciously going in. Even if you're going to buy something, know exactly where you're going to sell it, right? But sell it now. Sell it beginning and then now. What happens if it goes down? What happens? If it goes up, you make money. If it stays the same, you make money on a put. If it goes down, oh, now what about that? What if it goes down to 79? And you get it put to you at 80? What is your cost basis? It's $80 minus the $3 you took in. Your cost basis is 77. So because that premium that's generated, the premium that you sold and took in, could be subtracted off of the cost basis and lower your cost basis, there's possibly a 3 in 3 chance that you might still make money, right? If the stock's at 78 and you bought it at 77, you can still sell it and make $1,000 because of that adjusted basis. So there's a potential when selling to have a potential. Definitely 2 in 3 chance of making money, but a potential of a 3 in 3 chance of making money with using the premium to adjust the basis down. Tell me what gets more exciting than this. I'm trying to convince Americans that if you're going to go into the stock market, strategy number 1 in your brain ought to get to be selling stuff before you buy. But every other book and every other person in the whole stock market is trying to convince people that the way to go is to buy so you have something to sell, or just buy and hold on forever. And for a lot of people, that might be true. So let me just deviate now and just talk to you about a lot of people. When I read these books, and I feel like one of my duties now is to warn, is to educate, is to cause a learning in this land, in this country, of right principles. See, here's what I see happening. I see big stock market type gurus back in New York writing these nice books and these nice magazine articles, and they're always talking about things like asset allocation. How many ever heard that word before? Asset allocation. What they're doing is they're saying to my clients, you know, I have my clients put 40% of their money into large cap stocks, 20% of the money into growth stocks, 20% of the money into foreign stocks, and 20% of the money into bonds. Right? I mean, have you heard that kind of stuff before? Well, I don't know who they're talking to, but they're people I don't think come to my seminars. Right? The people that are coming to my seminars and reading my books barely can scrape together $2,000, $3,000, $4,000, $5,000, and yet they want that money to go to work for them. Anybody in that group sitting here in the room? You got $5,000, $10,000, $15,000. That's a miracle if you could get $20,000 scraped together, correct? So you don't have hundreds of thousands of dollars and $5 or $10 million. My goodness, somebody comes to one of my seminars and they walked in the door and they heard me and they can barely scrape together $2,000 to put in the stock market, and they walk in the door and I talk, well, you need 40% of your money in growth stocks. That's $800. You need 20% of your money you need in, that's $400. You need 20% of your money in bonds. That's another $400. My goodness, where would they be? And I'm saying, take your $2,000 or your $4,000 and put a 500 or 600 here or 800 here into options and see if we can double that money, right? And then get it going and turn it into a machine. You see the point? They don't have the luxury of millions of dollars. I contend virtually every magazine article I read is read by people who, by the way, would turn away at the door the average person that comes to my seminars. You don't have enough money. You need to have at least $50,000 or $100,000 to open up an account here. And most of my students would just walk away. They could not, they don't have $50,000 or $100,000. So again, I guess that's why I'm being criticized so much, because people are trying to compare Wade Cook to all these other people out there. And all these other people out there are these big market people that take on million-dollar clients. And I'll go out and take on the cab drivers of the world and try to educate them, and the butchers and the bakers and the candlestick makers, and try to get them, those guys up to speed, those guys up where they can give more to their church. Had a really cool experience in Orlando last week at our Semper Financial Convention. One of the neatest testimonials I got was by a guy who took $11,000. He started with like, I think 13 or 14, and he made like $60,000, $70,000 and took $11,000 and bought new bells for the steeple of his church. You know, new bells for the church so they could have beautiful music on Sunday mornings. Isn't that nice, by the way? $11,000 to buy bells for the church. And so I want to get that testimonial on a tape recording, by the way. And he says, well, that was the nice thing I did, but the selfish thing I did is I paid cash for a new condo out by the lake. Paying cash for condos, nothing to hide about. But he wanted to tell that story about the bells for the church first. That's okay, right? So again, the third chance, all that of making money. All right, now we've talked about page 11. So now let's move on. And before we take a break, let me share with you this next thing. The stock market is the most interesting place. And as I go through this part about red light, green light, and that's what I'm calling it, red light, green light, I think that you'll be able to see a lot of things about the stock market, maybe observations that you've never seen before. I want to make sure that as we invest in the stock market, that we stack the deck in our favor, that we make every possible move, understand every possible thing that we can understand to quit making mistakes. By the way, isn't that a good point? So if in the next few minutes, if I can share with you some ideas that will help you make more money, like a $4,000 option becomes a $6,000, what if you could just make an extra $500 or $1,000 on every trade with better timing and better exit strategy getting out of your transactions? What if, by the way, instead of those $4,000 options that become worth $3,000 or $2,000 and you have to sell for a loss, what if you could avoid making those stupid decisions? We all make them, by the way. The famous basketball coach said the way you win basketball games is to not lose. Well, I'm going to contend that the way you make money at the stock market is to not lose. Got to quit our losing ways. And if we could eliminate one or two of those per month, things that cause us to lose money, and just do those smart things. So I'm going to dedicate this next section to all of us that want more consistent cash flow, more consistent ways of making money in the stock market. And the stock market brings together a lot of strange things. And I am now a president and CEO of a publicly traded company. Which reminds me, by the way, did anybody see that discussion at that public forum between the president of General Motors and Bill Gates from Microsoft? Well, Bill Gates from Microsoft got the podium first, and he got up and he said, if automobiles had kept up with computers in terms of pricing and speed, if automobiles had anywhere kept up with computers, today we'd have an automobile that costs less than $2,000 and gets 1,000 miles to the gallon. A little bit later, the president from General Motors gets up and he looks back at Bill Gates and he says, yeah, but who'd want a car that crashes twice a day? I think that we need to get better at our powers of observation. Parts of my new books are about this, powers of observation. I had a chance of watching a TV show, HBO movie, and I was in a hotel room somewhere getting ready to go teach a seminar, and it was a story about Galileo. If you ever get to watch this story of Galileo, it's very fascinating. The gist of this part of the story was that the queen had given her obnoxious son, the prince, over to Galileo to train him. And at first, the boy didn't want to have anything to do, but he did have a little bit of an inquisitive nature. But he was like 13, 14, 15 years old, and at first it was kind of a weird go. They didn't get along very well. But day after day after day, when this young boy got to see Galileo doing these experiments and doing all these things, he was fascinated by some of the stuff with astronomy and some of the stuff with weights and things like that. And they argued and they debated. And at the very end of the segment of the movie, Galileo says, if you're going to be successful as a scientist, you need to do these three. I really think, he said four, so I'm going to give you the four things that he said. He said, number one, you need to observe things. You need to get better at your powers of observation. You need to start seeing connections between things and start observing things and seeing what makes things work. He says, number two, once you've observed something, number two, then you move on and you watch for trends. You watch for exceptions. You look for variations, and you look for things that happen that consistently go and consistently work according to what you've observed. Number three, you formulate a hypothesis. You formulate in this discovery process, you formulate what you think would happen under certain circumstances, and then as part of that formulating the hypothesis, you test it, you try it, you test it under different situations, and you work out the hypothesis to prove that it's true. And if it's true, if you can continually prove the hypothesis, then you formulate a law or a rule by which to govern. When I saw that, I just could hardly I could hardly think about anything else. I was just sitting there staring at it. I said, you know, that's what I do. If there's anything that I do in the stock market, is to study things, observe things, watch for trends, try to notice things, look for connections between the dots, then put it all together, test it, try it. See, what you guys don't see here as students that come through my seminars, you don't see the 20, 30 ideas that people tell me about or that stockbrokers mention to me that don't work consistently. They'll tell me about some stock that did this, but when I try to see if any other stock in that same category does this, it doesn't do this, right? But when I see stocks doing stuff consistently and forming trends and doing things at the same time in the same way, then we start looking at it in different times of the year. We start trying it out. And before we ever teach anything in the seminar, we not just observed it, we have tested it and walked the walk and made money with it, real live money, so we can go back and say, look, here is our track record. Here is what we've done with this thing. I'm going to show you several of those throughout the day today. In addition to the spread and butter, you're going to get several of our recent observations. You were coming up on one of them right now. Before we get to bull call spreads, I want to share with you one observation. And by the way, by the end of the day, we're going to go back and look at bull call spreads and bull put spreads and all the others in relationship to this red light, green light process. So let me tell you this observation that I made. Most of you know I'm the president of a publicly traded company, Wade Cook Financial Corporation. We've been publicly traded since May of 1995. We became a reporting company on June 30th of 1996. And when you go over $10 million in assets, you have to become an SEC reporting company. Once you become a reporting company, it is amazing to me how many laws and rules there are that govern the activities of CEOs, Chief Executive Officers, CFOs, Chief Financial Officers, COOs, Chief Operating Officers, CLOs, Chief Legal Officers, other insiders that may know something about a company, and of the board of directors, people that know the finances and the things about a company, the direction of a company, mergers and acquisitions and share buybacks and things like that. The people that are in the know have certain time periods when they can say things and other time periods when they have to be absolutely quiet and cannot say anything. And also, in addition to that, there are times when we can do things and times when we can't do things. For example, there are times, windows of opportunity, if you will, when we can buy stock in our own companies. And there are times, right, that we cannot sell them. So, like, for example, at the time of this taping, our stock was right around 40 or 50 cents. I can't buy the stock around 50 cents. And 3 days later, right after the earnings come out, go out and sell the stock at, say, 75 cents and make a quarter on my own stock. Y'all say, I can't do that. I can't take advantage of inside information, of knowledge, and do that sort of thing. And it's good. It's good for the investing public. Those are a few of the rules that I agree with. They're really cool. They protect people. They're really good. But then I start asking myself, if I, as a CEO of a publicly traded company, cannot say things at certain times of the year, all right, like what times? Like right before the earnings report every quarter, right? I can't say things. If I can't say things right at the end of the year, because if I know kind of the earnings of the company, and I can't talk about the earnings and what the earnings per share is, because don't a lot of people base their decisions on buying stock on the earnings, the PE or the earnings of a company. So if I have information right before the earnings come out, I cannot disclose that. I can't even come in here in this semi-public setting and tell you as an audience, because that then would be deemed that you would have inside information and the investing public does not have the same information. Y'all see that? So I can't tell one audience or one seminar group of people those things and not tell everybody. You just can't do it. So I started thinking, well, if I'm under those restrictions, if I have those constraints in my life, I wonder if there are other CEOs. The answer is obvious. CEOs, CFOs, CLOs, probably about 5 to 10 people on the board. I would say about 10 people per company cannot, during a certain period of time, say things about what's going on at their company. Well, there's 25,000 publicly traded companies in America. Take 25,000 times 10, that's 250,000 people in America for a 2 or 3 week period of time are shut up from talking about their company, right? And then after the earnings come out or right before the earnings come out on an estimated basis, there's a whole period of time when they can all start talking about their company again. So what happens when they're all talking about their company? What the direction is, mergers, share buybacks, and all this talk is going on, what do you think is going to happen with their stock? It's going to go up, or at least, what if it's bad news, though? If they all start talking about their companies is really negative, what's going to happen to their stock? It's going to go down. So here's an interesting question for you all. Do you think that the stock goes up more? There's no hard answer to this question, by the way. There's no right or wrong answer at any given stock, but I'm just going to pose the question anyway. Do you think that the stock rises more in anticipation of news or upon the news, when the news is out? On the anticipation, more than likely on any given day. Whoa, is this an interesting observation? So let's continue. Let's continue and show you a few things that people that are in publicly traded companies, that the constraints that they're under. So let's talk about the dates, first of all. We'll start with December 31st, and we'll come back to this in just a minute. Let's go to March 31st. Then the next quarter date is June 30th, September 30th. Those are your 4 calendar quarters. Now let's make several comments about this. Most companies in the United States have a December 31st year end. Most companies do. They don't all have to have one of these 3 or 4 calendar quarters as their year end. But most companies, even though they do not have a most companies have a December 31st year end. And some companies, even though they do not have a December 31st year end, usually choose one of these other 3 dates as their year end. Now, there's a reason for this. See, and by the way, I don't want to say it's a big government conspiracy to get everybody in America acting the same, marching to the same drumbeat, doing the same things at the same time, but it sure looks that way. Because watch this. How many of you have had your own businesses before? Okay, I'll give you one example. 940s and 941s. Need I say more? If you've been in business for yourself before, you know what I'm talking about. You know now why a company, even though it would like to have a January 31st year end, which some companies do, like Dell Computer has a January 31st year end, and there are other companies that have off-calendar quarters like this. They're not even on a calendar quarter, but most companies choose a calendar quarter. Why? Because all their employee records, like their 940s and their 941s, have to be filed on a calendar quarter. So even if they want to have a January 31st year end, they still have to go for all their government filings of all their employee records December 31st and then March 31st. So it's almost as if they have to have 2 sets of books. They have to have one set of books for all their government filings and then one set of books for themselves. You see how I'm serious? It's just too much paperwork. So most companies have a calendar quarter. The most popular one, as I said, is December 31st. June 30th is the next most popular, then September 30th, and then March 31st. All right. You will see from time to time, as we go through these examples today, a few companies that have off quarters, off calendar quarters. But let's just stick with most of the companies. We're going to start now with March 31st. When a company, which is, again, a publicly traded company, does its filings for the SEC, it comes up on the calendar quarter, and it has to do its what are called the 10 Qs. That is, a Q stands for quarterly. When a company does its 10 Qs, it has 45 days to do those filings, which March 31st would put this first 45 days at May 15th. So any time before May 15th and after March 31st, the company will do its actual filings. Little quick interjected point here. If any of you would like to look up anything about these companies, find out about their Form 4s. And by the way, whenever you talk about insider reports and insiders buying or selling, that is called a Form 4. You can look up any information, quarterly reports, annual reports, any other kinds of filings, Form 144 filings would be like registering their restricted stock for sale, any of those types of filings. You can find these on the internet now at edgar.gov. Edgar, E-D-G-A-R, Edgar. So what we have to do to get all of our filings done now every quarter is we take them to downtown Seattle to an electronics filing firm, right? And they take all of our stuff in and Edgarize it and get it all ready to go, push a button, and it's off onto the internet on a site for the SEC called edgar.gov. Now, knowing what I just showed you there, the internet site .gov instead of .com, it's .gov. You can go and look up any filings of any company out there. Just there's an index, there's alphabetical listings and all that, and you can just go find any company out there. All right, now let's go on though. This filing here on March 31st does not have to be audited. It can be an unaudited filing. Okay, and on June 30th, to do its 10 Qs, again, the company has 45 days, which would put it at August 15th. September 30th, to do its 10 Qs, again, there are 45 days, therefore putting that at November 15th. And now again, companies always don't wait until November. They wait until, if it's September 30th, October 10th, October 20th, October 29th, November 5th, they will get their filings done. Okay, now, things change a little bit as we come up on the year end. Because the year end filing, the 10K, the annual filing for the company on December 31st for this example, but again, Dell has a January 31st year end, therefore it would have 90 days. So they have 90 days to get their filings done. 90 days, which by the way puts it at March 31st. Look at this. Do you see some crossover times here? At the end of March, when they're trying to get their annual filings done, is also the end of the first calendar quarter, right? When they're coming up on all the numbers that have to be crunched out for that. Okay. Anyway, this statement, by the way, has to be audited. The annual filing has to be audited. That's by the way why they give them so much more time, because they have to you have to bring in outside auditors. You have to make sure all the legal stuff is done up, and everything has to be done. It takes a lot of work at the end of the year. Now, the reason I'm showing you all these dates is just number one, so you have them in your brain, so you're thinking all the time. As I move on through this discussion right now, I don't want anything I say to be taken in a general nature. You have to look at what I'm saying and apply it to each company, because each company files its reports at different times. One of the things, if you want to make a lot of money in the stock market, that you need to get good at is to find out when a company has its board of directors meeting. More so than even the annual shareholders meeting, but a board of directors meeting. Because in just a minute, we're going to talk about OMFs, other motivating factors, stock splits, share buybacks, earnings reports, dividends, mergers, IPOs, spin-offs, all those things that could be negative or positive, usually positive for the stock, is going to come out if and when the board of directors meets. Let me say it another way. Nothing is going to happen until the board of directors meets. All right, so let's move on. Now, this will all start to make sense here in just a minute. Have you ever seen something like this? You come up on June 30th, and I'll bet a lot of you that have been really watching the stock market, as students of the stock market, have seen something like this. Oh, it's about June 15th, not too far away from the June 30th calendar quarter, when the 10 Qs have to be filed. On about June 15th, June 17th, the company starts talking about their earnings. Now, the earnings that are going to come out sometime in July, and they may even have the date set when they're going to announce their earnings. When the earnings are going to come out sometime in July or the first week of August, remember, when do they have to be filed? Do you remember this? They have to be filed by August 15th, 45 days later. The company will start talking. The CEO will come out and say, we really don't think that our stock is doing, or our earnings or our sales have been as good as everybody thinks that they're going to be. Everybody's saying, or we've been even saying, that our earnings were going to be like $1.32 per share. We don't think so now. We think that we're going to lower our earnings estimates down to $1.12. Right? And then on July 10th, right after the calendar quarter, when they actually do their filing, they come out with an announcement along with their filing that says, we did a lot better than what we thought. We did $1.22 per share, $1.22 per share. We're 10% ahead of estimates. Now, seriously, how many of you have seen stuff like this happen? If it wasn't so comical, it'd be totally pathetic. The SEC, and the way they have people that report about their companies, are training the publicly traded company presidents and CEOs and insiders to good mouth and bad mouth their companies all at the same time. They'll say, and our earnings are better than what we expected. They're $1.22. They're 10% ahead of estimates, but we really don't think they're going to be good for next quarter. You seen that kind of stuff going on too? So they're good mouthing and bad mouthing their company all at the same time. Why? You got to actually remember, the person who knows why will always be the boss. Why? Why? Because they don't want to be seen to be hyping their stock too much. Right? That's another big taboo with the SEC, right? To talk too much about your stock and tell everybody and have just wild estimates out there, right? So everybody's kind of curtailing their estimates all the time. But then right before the earnings come out, they can say, well, we beat our estimates. Whose estimates? And by the way, what happened to the stock here? Here's an interesting trade for you right there. You come up on the middle of June, and as all these earnings come out, people start bad-mouthing their stock, and the stock goes from $86 down to $81. Where is it, by the way, by July 10th when they actually come out with their numbers? 92, right? It's gone right back up. So it climbs back up to 92 because do you ever get a feeling that we're the last ones to know, by the way? That there's a whole bunch of people in America, the analysts and all these people that follow the company intently, and they all know this stuff, and the stock runs back up to 92 by July 10th. And as soon as July 10th hits, and they come out with their estimates and they say all this stuff, as soon as July 10th hits, and they do their earnings actual announcement, and the stock's at 92, far too often what happens, and it's awesome. Better than, more money than they've ever made in their whole life, and what happens at $92 stock the next day? It opens up at 88 and then falls to 82. But how many have seen that kind of stuff happening? So often. Very seldom do you see a company going from 92 up to 95 on the earnings. Very seldom. Why? Because all the play is into the estimated earnings, into the anticipation of the earnings announcement. Very seldom, unless they just blow their numbers off the door with their earnings, right? Instead of $1.12, they come with $3.12, right? Totally changes everything. Then the stock will go up a little bit and then fall back later. Now, I'm telling you all this. I'm sharing with you this and hopefully giving you some insight to this. So let me now tell you what I discovered. I'm going to use two different colors of ink. I'm going to use red light and green light. Green light will eventually become the time at the beginning of a green light period when we want to buy the stocks. Red lights is when we want to be careful, possibly sell out and clear out of some positions. Okay? So green light is a go, red light is a stop. Right? So as I go through this, I'm trying to slow down right now because I don't want any misunderstandings here. Again, I'm going to give you some generalized information. Each company has to be looked at under a microscope. Why did it go up, differently than what Wade said when it should be going down? Because they don't all fit this pattern. And sometimes when they don't fit this pattern, and you do some research, you'll find out that they don't have a December 31st year end. They have a January 31st year end. So they're a month off. And they're going up when I think they should be going down. But here's what I've noticed all in all. I noticed that in the month of February, it becomes a really, really bad month period of time. February, the stocks will just fall. And they'll keep falling until about March 15th. Now, why March 15th? Right there in the middle of March. And for some companies, it's the 17th. For some companies, it's the 25th. Before March 31st, before the end of this first calendar quarter, they can start talking about their stock. This is the newsy period of time. We're thinking about this, we're thinking about this, we're going to have this and this and this, we might beat our earnings expectations. This is where everybody starts talking about the company. This becomes a news time. And I contend that stock needs fuel. They need gasoline to go up. And the gasoline is news. Now, we live in a pretty good economy today. And about 20%, and today's, this will change, but today, about 20% of the news is bad, and about 80% of the news is good. And it will have that same kind of effect on the stock. About March 15th, when the news period starts, a lot of stocks will start to rise through April, which is the news reporting period. You know what? I'll bet a lot of you have heard the expression. And as soon as you go home and tell this to your stockbrokers, they'll say, I know that. Well, why didn't you tell me? You're going to ask them. Because I contend that they did not know that. I contend that this humble cab driver has discovered something here that is so profound and so important, and everybody knows bits and pieces of it, but nobody has asked the question, not anything I've read on this at all, anywhere, that says, why? Why does this happen? And I'll tell you the answer. It's real simple. Because they start talking about it. It's that simple. And when the stocks start to fall, it's because they're not talking about it. So you've heard things, even on CNBC, they'll say things like, well, we're entering the seasons, the earnings season. Have you heard that before? The earnings season. Well, it's happening now, about mid-June. Now, this tape recording was done, the second week of June. And as we come into this earnings reporting season, which is June 30th, you're going to see a lot of stocks start to pick up right about now. And we've got an expiration date in a week and a half. And through the 15th and through June and July, you're going to see a bunch of really cool things happen. So So April, the stocks will go up until about the first week of May. And then May will just die. It'll be a horrible month. By the way, what has happened this last May with the whole Dow? It was 11,100, 11,200 at the beginning of May, the end of April. What happened to it? How much did it go down? It got down to clear down to 10,300, 10,400. If you look at the Dow, according to my red chart right here, you'll just say, man, did he nail this? Right? It's not going to happen every quarter, but it sure has happened this month of May. By the way, I'm going to suggest here very quickly that you go on vacations in February, May, and August. Just get out of town. Just take 3 months off and go somewhere. If you're going to be around, you got a special kind of trading to do. Matter of fact, a chapter in my whole new home study course called Red Light, Green Light is going to be called "'Tis the Season to Be Folly." Okay, because during those you'll see 4 times a month, 3 full months in 1 2-week period of time. All right, so in the month of June, about midway through the month of June, right there, when the news reporting period picks up again, starts heating up again, you'll see some pretty erratic stuff all the way through July. Once again, based on the quality of the news. So it's just not that a stock is going to go up. The news has got to be good. And then in August, it will die. It'll be worse, more bloodshed than the month of May. You'll wonder why you ever do anything in August. Okay? And about mid-September, it will pick up again. Pretty interesting, because October, I think, is a weirdly weird month. Very erratic month. Anybody agree with me on October? It's kind of like every time we have an October, we get to the first week of November, and everybody goes, whew. We got through another October, right? Stock market crash in 1929, the stock market crash of 1987 all happened in October. It's like such a strange month. Other things go on in October. I'll give you an example. Mutual funds that have losses in their stocks. Mutual funds, not us, but mutual funds. If they have a stock that's gone from 90 down to 30, and they want to sell it to get a tax loss at the end of the year for selling that stock, they have to do so by October 31st. There's a lot of buying and selling going on in October. It is a pretty erratic month. Now, my reports say then that November, I'm going to put 2 colors up here, that November is pretty much of a flat month. I'm going to put the green up here, the red and the green up here. November could have an upward bias or a downward bias, depending on pretty much what happened in October. Now, what I've noticed is that the first 2 weeks of December are killer months. Just killer, those 2 weeks. And then most stocks will rally into the end of the year. And then most stocks will just fall flat in January, or some of them will stay flat. I've only seen just a few go up. And they'll just fall in the month of January through February, and then they'll pick up again in March, right, and take off again. And I just see this going on all the time. So now with that in mind, it's going to be really tough to do this, but I'm going to, it's going to be tough. What am I going to do? All right, I guess I'll just have to do it this way, because I usually lay a transparency over a transparency, but I cannot do that. What I have here in my hand is all 30 of the Dow Jones stocks. I'm just going to randomly go through here and pick one out. Right? And it's going to pick one out, and we're going to lay it up there, and I'm going to do the red light, green light with this one right here, which is Goodyear Tire. Okay? Let's just see. Now, this is from February of 1998 till February of 1999. I wanted to show you the year end in 1999. The year beginning, actually, of 1999 and the year end of 1998. All right. I contend that February is a pretty weak month. This one here looks pretty flat right there. It did go up in February. And then as you get to the middle of March, right here, the stock will run up. And then again, based on the quality of the news, I say that March should be a good month. This one went down in March, but then May will just be a flat and a killer month. It'll just go down. And it'll go down especially up until that second week of June. In the second week of June, it will run back up. Now this one started a free fall. Usually July is pretty good for a lot of these companies, but remember 1998? The summer of 1998 when a lot of stocks went down. Look at this all the way through August. Right, bounced around here. The middle of August will spike up. Usually, look at this, even though it went down right here, it ends up about the same where, usually October is a good month. November is a flat month. The first 2 weeks of December just die, and then the stocks will usually rally in to the end of the year. Okay, this one's just slightly off, but let's go on. Let's try another one. Here we are in the Northwest. Here's Boeing. Let's take a look at Boeing. Boeing has some special news type things that happen, right? Every time they get a big order for jumbo jets, big jet orders anywhere for Boeing, it used to be every time they got a big order, the stock went up, right? Lately, every time they get a big order, the stock goes down because they can't produce them fast enough. So the earnings can't grow, even though it's very, very busy and they're making a lot of money. It just can't grow the earnings. See, people don't want just earnings. They want earnings growth, right? And Boeing needs to build some more plants, right? Boeing needs to make more planes, all right? But let's go through Boeing. Okay, let's do the red light, green light. February, this February started here, down, went back up. Look at this. In March, right there in the middle of March, the earnings season spikes up. And then whatever, I don't know when it does its earnings report. That's the point. Then May is going to be a bad month all the way to the middle of June. June will turn around and spike up to sometime in July when they actually make their earnings announcement, and then August is going to die. Go somewhere in August. This is no joke. I can't tell you what to do, but I'm telling you where we're going to be. The last week of July and the first week of August from now on every year, we're going back to cash. We're clearing out of every leap, every stock, every position we have, we're going back to cash. And we're going to wait till like the end of August, the first week of September, then we're going to start. Now, we'll do some buying puts during that time, right, to write some things down. We'll do some bear call spreads that you'll see later on. We'll do a few other things like that. But why would I hold a stock at 120 and say go to 90 over the 1 month, then sit there at 90 waiting for it to go back up, and I got to wait months for it to go back up? Why not sell it at 120, buy it again at 90 the first week of September? Does that make sense to anybody else here? You do what you want with this information. In this August, I'm clearing out of everything. You know, I'm going to be gone to Chicago, and I'm going to go up to Regina, Saskatchewan for a horse show. I'm going to be gone anyway, right? If any of my trading department wants to take vacation, do it in August, right? Because we're not going to be in the market then. All right, now, so then about mid-September, these stocks usually run up. October is usually a fairly good month. This one, September, was up, but it really, September was up, but it's still flat. Started there, ended there, even though it went up and back down. Then it dies the first 2 weeks of December. You know, you're starting to get a handle here? Look at your chart there. What happens in the last part of December with most of these companies? They rally into the end of the year, and then they die in December or January. Okay, let's just pull out another one. Here's Caterpillar. Okay, again, these are the Dow 30 stocks. February is usually a very weak month. This one was up, though. As it gets up to here, to the middle of the month, I don't know where it was. Look at March and April. This one even had a May that went up here. May should be a bad month, but this one, May went up, but it ended up down, and all the way down to there in June. Mid-June starts there, it starts to run back up. Then what happens after the June earnings, after the July earnings are out? What happens, everyone? You starting to get it? So August is going to die, right? Sometime about mid-September, look at this. It's like clear down to here. Mid-September, it runs back up, and there it is in the end of October. October is usually a pretty erratic month. November is usually flat, falls down the first 2 weeks of December. December 15th, it'll rally into the end of the year. Is anybody starting to catch a theme here? I can put all 30 of them up here if you like, and you'll see pretty much the same trends. They're not all exactly perfect. Is that okay, by the way? But it gives you some trends to start playing, some times to start watching out for. So what are your scary months right now? Now you're going to have to learn new strategies. 'Tis the season to be folly. What are those months? February, May, and August, and the first 2 weeks of December. Okay, as y'all say, let me just do a couple more. And then I'm going to show you some reports that have been put out by Standard & Poor's. Okay, here's Exxon, big oil company. Here's Exxon. Runs through here, this period of time, mid-March, right there. Look at this, mid-March, when it starts into the new newsy season, not just the earnings season, but the news. See, this news doesn't have to be earnings. This news could be what? This news could be a share buyback. How about a stock split? How about a stock split? Here's the point. What if a company announces a stock split right here in the news period? The stock runs up like crazy, right? It runs up like crazy. And look at this one. This keeps going all the way through April. Then what happens in May? What if the stock, when it's falling down all the way back here to the middle of June, what if the stock actually splits right there? So I need to get you to write down a question right now. That is probably the most important thing, the most important question you will learn this day. You get this question in your brain. You ask yourself this question all the time. Here it is. When you're getting ready to buy a stock or an option, you need to ask yourself this question. Here it is. What compelling reason does this stock have to go up? Let me say it again. What compelling reason does this stock have, or what compelling reason does this option have to go up? What if you're thinking about buying a call option in the middle of May, right? And the stock is right in its no news period of time. Nothing is going to start coming out in the news again until like mid-June. You're thinking about buying a call option for the month of June, and everything, if you look at these charts, is a downtrend. If you're buying a call option, could that be folly? Could that be a bad deal? What do you think? Because what does the stock need to go up? What does the option need to go up? It needs a new batch of news. Well, the new batch of news is not going to come out until when? Until June 15th or June 17th or June 20th. Now, a couple months ago, I started to teach this to our instructors who are out and about teaching the Wall Street Workshop. They were all in town on March 15th and 16th for 2 days of speaker training. I was telling them this whole process here. I was going through this red light, green light, news, no news, news, no news, red light, green light, and I was trying to show them how all this worked. And I said, now let's just take Microsoft, for example. Microsoft has just been weak. You know, it tumbled and it tumbled and it tumbled, and it was up around 90, 95, and here's around 84, 85, down to $80 a share. And I looked at them and I said, what does Microsoft need to go back up? And everybody's starting to catch on. Well, it needs news. And I said, now you watch. In the next hour or two, I said, oh, hey, today's March 15th. Today's the day. It starts into the news period. And sure enough, within an hour, Microsoft made an announcement that went over all the airwaves that said something like, they're thinking about dividing the company into 5 different divisions. Remember that news that came out about 5 different divisions to get ready for this government settlement? And then, bam, 2 hours later, Microsoft is in talks with the government to end this lawsuit. The next morning, Microsoft is going to blow away its numbers. And the stock went from like 80 up to about $88 in 2 days. And I walked in front of all the speakers and I said, see? I was trying to make a point there. Here we are March 15th and all the news starts up again and the stock starts to fly up 10%, $80 up to about $88. Is that amazing to anybody else here? It needs the news. If it doesn't have the news, it's going to be weak. Why? 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 You've got to keep asking that question. And it's simply because there are times when people at Microsoft or Wade Cook Financial, there are people at Amazon.com, and there are people at Yahoo when they can say things and when they can't say things. Can I give you an example? On March 31st, the calendar quarter ends. Before they actually do their filing on April 20th, would you think that the investing community would suppose that if the CEO talks about the earnings on March 5th or March 7th, that he knows what happened for the previous quarter? Let me ask this again. The quarter's over. March 31st is over. They haven't actually done their filing yet, right? They haven't done their earnings filings yet. But if he starts talking about his company, would it be seen that he should know about what his, even if he doesn't know exactly what they're going to be, but he should know whether they're good or bad, yes or no? Therefore, they're not going to let him talk. Okay? They're not going to let him talk until the earnings are actually filed. So you rally into the anticipation of the ending of the quarter or the ending of the year, right? And by the way, does anybody know what a company does on December 31st? They don't know until what? Usually they do their filings in February or in March for the year, and then the stock starts to move back up. All right, just one or two more. I hope that you're catching this because, well, let's just finish off Exxon. So the middle of June rallies again through August, through July. Then August will become the red light period of time. Look at this, down, down, and down. Clear up here now until the middle of September. Middle of September, it starts picking up again. Look at this, all the way through October. November will usually be a flat month. It went way up at the end of November, then fall down at the beginning of December. And then what will it do at the end of December usually? This one here spiked up, rallied right there into the end of the year, and then January is going to fall again. How many of you like this stuff besides me? Anybody here? Is this amazing? All right. By the way, I was showing this to my wife, and she just sat there and watched this for a while, and then she made a comment. She said, Wade, the reason you've observed this, because most people are always on the outside looking into the stock market. You're on the inside, right, of a company looking out, what you cannot say, what you cannot do. She says, now as an educator, all you've done is tie the two together because you're on the outside looking in and you're on the inside looking out. You're saying, what can I do, what can I and can I not do as a CEO? And then you just tied that to what goes on in the market with everyone else. So if you think about it, I'm no genius for figuring this thing out, but it definitely is very interesting. And I'm not trying to take credit for anything. This has been going on a lot longer. All I'm trying to do is put some meat on the bones. All I'm trying to do is to understand it and more importantly do what? Play it better. What does this tell you now if you're thinking about buying a call option in the month of May? And what does it tell you that even though a company may make a stock split announcement in June and it has incredible earnings, the stock has gone up? Everybody write down Ameritrade. Earlier this year, about 3 months ago, this stock went from $50, from $40 up to $158 in like 2 months in anticipation of all this stuff. Now, it's backed off to around 85 right now, By the way, does that look like a good support level if you look way back here? And I played it a whole bunch today. It's getting ready to do a 3-for-1 split. So I bought the July, it's doing it on July 2nd. I bought the July $90 calls. I did some bull put spreads on it and all that. By the way, do you like 3-for-1 splits? I do. And we'll talk about splits later on today too. Again, I could show you chart after chart after chart. What I'd like to show you though is that as this became very important to me, I was talking to some stockbrokers. Most of them just stood and stared at me because they were thinking about all the good advice and all the bad advice they've given to their customers over a long period of time. All the times that they got people involved in a stock at $90 and couldn't explain why it was down to $80, right? And then it took 6 or 7 months for it to recover, like the vicissitudes of a stock going like this. Well, I'm not saying to be a day trader. I got a real lot of problems with the word day trading the way it exists today. But what about being just a better, more timely trader so that you're buying stocks when there's the highest likelihood that they're going to go up? And if you don't particularly want to own them when they go down, get out of them when they're going to go down and buy them again when they're going to go up. Definitely for those of us that trade options, should this and could this be a definite eye-opener, an awakening, if you will, to say, don't do stupid things. Don't be buying call options right when the stock is going into its no-news period of time. There's nothing to support it. Now, another quick little point. Could a stock rise up in a no-news period of time if there's extracurricular news that comes out? Yes or no? Yes. So it's not infallible, this thing. For example, if Microsoft were to end its lawsuit with the government, win, lose, or draw, is that stock going to go up? What if it happens right in a no-news period of time? Okay? And here we are again, coming up on the middle of June, and we're already starting to see some stocks starting to pick back up, stocks starting to head into stock splits and all that. Now let me show you this. This is research that was done by Standard & Poor's. Market performance each month of the year for 40 1/3 years from January of 1950 to January of 1991. Now, I will grant you that the market has substantially changed since 1991. Will you all agree with me that the Internet is changing everything? It has changed the way we do business in America. It has and it will change everything. In 1991, I would say most of you in this room, including me, did not even know what the Internet was. Is that a fair statement? 9 years ago, 8 years ago. We didn't even know what it was, right? And all of a sudden now, ready access to information. Easiness of getting at information about companies, trading stocks and doing stocks on the stock market. Everything is changing right now. So, but what I want you to see is that for 40 years, stocks in this research were up for over a 40-year period of time. Look what happened in February. They just died, right? They rally again in March and April. Look at the month of May. It's even a negative month. They rally through June and July. Look at August, right? Then September was down as it rallied back into October and November. Now, my research shows for the last couple of years that November was pretty flat. But in this research over the last 40 years, November has been a very, very good month, as this has December. Now, I still think that in my research it shows December going down, but coming back up big time by the end of December. So it's a little bit deceiving. But by the way, could you make some money knowing that a particular stock is going to go down big time the first 2 weeks of December and then rally into the close of the year? Do you see that? But look at this research. 3 months, and I said to you before, go on vacation in February, May, and August. What does 40 years of research tell you to do in February, May, and August? There you go. I just gave you all more extended vacations than you were planning on, right? So hope you appreciate that part of it. But it's at least teaching you to be smarter with these trades, teaching you not to get involved when certain things are happening, et cetera, et cetera, et cetera. All right?